Hi, this is Monica from Dhaka International University, batch CT2B, roll number 35. Today I am going to discuss about existing entry. What is existing entry? Existing entries bring certain account balance up to date at the end of the accounting period. Existing entries are made after preparing total balance at the end of the accounting period. Existing trial balance is made after positing existing entries to the ledger. Difference between and cash basis accounting. Accrual basis accounting, when any transaction performance occur and it has written on that date that will be occurred. Accrual basis accounting. Cash basis accounting, if any transaction performance occur but money not paid yet, that will not be mentioned on that working day. Account will be mentioned on which day or what day you get your money. It may be taken 3 or 4 or 5 days. Why is accrual basis accounting better than cash basis accounting? Accrual basis accounting applies the matching principle, matching revenue with expenses in the time period in which the revenue was earned and the expenses actually occurred. This is more complex than cash basis accounting but provide a significantly better view of what is going on in your company. Reason for existing entries. It can be inefficient and costly to account for certain type of transaction on a daily basis. The main purpose of existing entries is to update the accounts to conform with the accrual concept. If existing entries are not prepared, some income, expenses, asset and liability accounts may not reflect their true values when reported in the financial statement. For this reason, existing entries are necessary. The basic of existing entries. Existing entries make it possible to report correct amount on the balance sheet and on the income statement. A company must make existing entries every time it prepares financial statement. Existing entries needed to ensure that the revenue recognition and matching principles are followed. Revenue recorded in the period which they are earned. Expenses recognized in the period in which they are incurred. So let's move on the next slide. Final part of existing entries. Final part of existing entries. 6 point. Accurate revenue, accurate expenses, deferred revenue, prepaid expenses, depreciation expenses, doubtful account and or bad debit. Accrual revenue. When you generate revenue in one accounting period but don't recognize it until a later period, you need to make an accurate revenue adjustment. Example, your business makes custom tote bags. In February, you make 1,200 worth for a client, then invoice them. The client pays the invoice on 7 March. You incurred expenses making the bags. cost of material and labor, workshop rent, utilities in February to accurately reflect your income for the month. You need to show the revenue you generated. First, you make an existing entry moving the revenue from a holding account to a revenue account. Then on 7 March, when you get paid and deposit the money in the bank, you move the money from revenue to cash. Now, accurate receivables is debit and revenue is credit. Then when you get paid in March, you move the money from accurate receivable to cash. Now cash is debit and accurate receivable is credit. Second one is accurate expenses. Once you wrapped your head around accurate revenue, accurate expenses adjustment are fairly straightforward. They account for expenses you generated in one period but paid for later. Suppose in February you hire a contract worker to help you out with your tote bags. You agree in advance to pay them $400 for a weekend's work. However, they don't invoice you until early March. Now, labor expenses is debit and accurate expenses credit. In March, when you pay in the invoice, you move the money from accurate expenses to cash as a withdrawal from your bank account. Now, accurate expenses is debit and cash is credit. Third one is deferred revenues. If you are paid in advance by client, it's deferred revenue even though you were paid now. You need to make sure the revenue is recorded in the month you perform the service and actually incurred the prepaid expenses. The conference showrunners will pay you $2,000 to deliver a talk on the charging phase of the tote bag industry. They pay you in January after you confirm you will be attending. You will speak at the conference in March. Now cash is debit and deferred revenue is credit. When in March, when you deliver your talk and actually earn the fee, move the money from deferred revenue to consulting revenue. Deferred revenue is debit and consulting revenue is credit. Prepaid expenses. To recognize prepaid expenses that become actually expenses, use existing entries as you use the prepaid item. Decrease your prepaid expenses account and increase your actual expenses account. To do this, debit your expenses account and credit your prepaid expenses account. This creates a prepaid expenses existing entry. Prepaid expenses. One example, say you buy a 1-year insurance policy for your business that costs $1,800. You pay upfront and use the insurance throughout the year. When you buy the insurance, debit the prepaid expenses account to show an increase in asset and credit the cash account to show the loss of cash. Now Prepaid expenses is debit and cash is credit. This month exists the account by the amount of the policy you use. Since the policy lasted 1 year, divide the total cost of 1800 by 12. Exists the accounts by 150 is month. Expenses of 150 of the insurance with the debit. Reduce the prepaid expenses account with a credit. Repeat the process each month until the policy is used and the asset account is empty. Expenses is debit and normally prepaid expenses is credit. Depreciation expenses. When you depreciate an asset, you make a single payment for it but disperse the expenses over multiple accounting periods. This is usually done with large purchases like equipment or buildings. Journal entries. Depreciation expenses debit. Accumulated depreciation is credit. The use of the contra account accumulated depreciation allows disclosure of the original cost of the asset. Last one is doubtful account and bad debits. The entry to right of a bad account affect only balance sheet accounts. A debit to allowance for doubtful account and a credit to accounts receivable. No expenses or loss is reported on the income statement because this write-off is correct under the earlier existing entries for estimated bad debits expenses and expenses that arise by selling on credit accounts on credit which an entity is unlikely to be able to contact. I would like to finish my topics. Thank you.